Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 24th of May. And after a many sessions of going up, market seems to be a bit confused at this point, with previous session also resulting in a nothing sort of a move on that day, and today's session also, if you see this last candle here, very indecisive, with morning opening gap down, then covering the gap, then going well into yesterday's territory, and then giving it back down by the end of the day. So extremely confused at this 18,300, 18,400 level. The likely cause is overseas indecisiveness regarding the debt ceiling issue in the US. I'm sure, very well sure, that you are aware about what is happening in the US. It is a annual sort of an affair where the government and lawmakers have to agree there that the debt ceiling should be raised so that they can borrow more, and it just they just keep kicking that can down the road without taking any measures to reduce their deficit right now. So most likely than not, the debt ceiling issue will get resolved in the next 1 week. So there are three possibilities that one is looking at. One is an immediate resolution between the two parties, and debt ceiling gets resolved. One is a doing a tough stand till the last minute, and forcing the current government to withdraw some of their spending, or reduce spendings at various points. And third is, of course, just not agreeing, and the government defaults. As soon as the government defaults, stock markets go into a tizzy, because technically the government has no money to pay from tomorrow onwards, and essentially it is chaos from that perspective. However, that is a situation which is not expected. Uh, Commentators like Jamie Dimon and others are saying that US interest rates are likely to go up further. That can be another reason for some, at least some resistance to the up move going here. The dollar index is also rising. The 10-year yield on the US is also rising. So there are some of these headwinds that are playing, which may be causing Nifty to take rest here, although Nifty has very smartly come up from the 16,800 levels and is only a few percentage away from the all-time high. In the Nifty heat map, you can very clearly see that the banking sector was the one which was leading the market down. So Kotak Bank, ICICI Bank, HDFC Bank, all down today. Some finance companies, Bajaj Finance, or insurance companies, SBI Life, etc., were marginally up. IT was flat. Uh, Pharma had some good gains in Dr. Reddy's, Sun Pharma, Reliance was down, Levers also down. ITC has been gaining another 1% up on that. Adani, after two very heady days of double-digit gains, have lost 6% today. Adani Enterprise, L&T is also down 0.5%. So a very mixed bag, with steel also taking some off today, with Tata Steel, JSW Steel also down a bit. Um, so not much can be made out in terms of where the market is headed. Pharma usually goes up as a defensive sector when the markets don't know what to do. FMCG also the same. So consumption for FMCG and pharma are defensives, and they went up today. Rest all sectors were down between 0.5%, and PSU and private banks both leading the market down. Metals coming off after 2 days of a good rise, with minus 1.6% here. So a sort of a mixed bag kind of a day. Mid caps, however, are in a different zone. Mid cap index is now above 33,000. So again, a new 52-week high, and now very very close to a all-time high again. So mid caps are not showing the kind of indecisiveness what large caps are showing. Small caps also not losing any ground today. 9729 is where the small cap 250 stands. Below 9600 or below this trend line is where we will start to see some panic come through, but I think that is not there yet. Nifty Bank, after staying in this zone of 43 400 to 44,100 for 6 7 sessions, today was a bit weaker, but then the volumes are also uh, not going up on a fall. So again, it may just be some consolidation here before it moves up. It remains within a percent or two of its all-time high, which is anyways not a bad situation to be at. Stock of the day is Engineers India. So this stock, which had broken out at around 87, 88 at the beginning of the month by a large move, has been consolidating, gradually going up, going up, going up, and today again a big move from 100 to 108 has happened. So always look for stocks that are breaking out with very heavy volume. So this move here, this 82 to 95 move with this kind of volume, uh, it will not be likely usually an isolated move. It will be there will be a follow up. It usually would cool off and then go up again, but here it's not really cooled off at all, and gradually it is going up, and this is now another move to another level now here. So many things to learn from each of these episodes, but what one needs to see is the price and volume action is really all that you need. Let's talk about small caps now, and some perils of investing in small caps, and is it time to invest in small caps. So now let's look at small caps in relation to Nifty, for instance. So the orange line is the small cap CNX small cap index. The black line is the Nifty 50 index. And what you can see that over the last nearly 20 years, both have returned almost the same returns. Nifty is 911%, and this is ex dividend, so you can add some dividend to it. Small caps don't have much dividend, so 1038%. So I would assume that these are pretty much the same kind of growth over the last 20 years. But what is different in the two is that every time a bull run is happening, the small cap index takes off, and the gap between small cap and Nifty keeps widening, and then the small cap crashes. Then it takes off, then it crashes, then it takes off, then it crashes, then it takes off, then it crashes. So now again the widening of the gap has started. Maybe it's the next leg of the bull run, we don't know yet, but this is a very periodic and repeating pattern, that if you just buy and hold the small cap index, and if your, let's say, your fund is based on the small cap index, then you will get a similar return to Nifty. But if you are holding a strategy or small caps which will uh, outrun the small cap index itself, and by having a proper strategy, if you are able to curtail your drawdowns, you will fare much better than the small cap index also. So this is the from ET Prime, a average up and down cycle duration of the Nifty Small Cap 100 Index. So you can see that every few years there is, like, for the 3x move, 3.4x move, 2.3x move, 2.2x move, 2.3x move, 3.6x move. So there is multiple, sort of opportunities available every few years in small caps where they move tremendously. Imagine if small cap index is moving up 3x, then there will be small caps which will move up 10x, 8x, 12x, so on and so forth. But the problem is that the downside is equally sharp. So 75% drop in 14 months, 40% drop in 13 months, 35% drop in 7 months, 25% drop in 7 months, 46% drop in 19, 65% drop in 26 months. Here 33% drop in 5 months. So huge cuts when they happen. So you need to have a strategy which can select stocks which will beat the small cap index when it goes up, and also protect some downside when they start to come down. If you have that kind of strategy, you will beat the markets, in a very very big way. This is the long term chart of the small cap index. Again, you can see that while the trajectory is up, it has very very sharp cuts on the way, and that is something that one needs to negotiate. Currently, of course, we are not at an all time high, but we are getting there. Just a few percentage away and you'll be at an all time high. And previously you can see that sometimes it does take a while to get to a new high, but once it does, you will get a booster here. You'll get a booster here. So once it does take out the all time high, you will get a good leg up. uh, as mentioned earlier, huge drawdowns after every bull run. 75%, 66%, 34%. So this is something that you need to take care in your strategy, how to tackle these drawdowns. So if I see overall buy and hold in this last 19 odd years, if you did a sip of 10,000, you totally invested 23 lakhs over this period. Nifty gave you 11.5% XRR and small cap gave you 9.94% XRR. So even poorer than Nifty returns if you see the small cap 100 index. But the beauty is that if you are able to select stocks that do better than the small cap index and curtail your drawdown, I think even more than selecting the stocks that run faster is the ability to reduce your drawdown. For instance, in momentum investing, various types of strategies, you can reduce the drawdown by a very large number. So that 75% drop will become 40% drop, or that 60% drop will become 30% drop, or that 33% drop will become 20% drop. So it is almost like, you drop less and then you can run again, then you drop less and then you can run again. So the idea should be to reduce your drawdown as much as possible. So exposure insights to draw from this small study is their exposure to small caps can be hugely rewarding. There is no doubt about that. But despite that alpha, we have noticed that small caps have much bigger drawdowns. So one need to assess your risk appetite also, asset allocation also before considering this segment. But once you are into small caps, then you invest in strategies that can outperform the benchmark in both bull and bear market. So when market is going up, you are beating the market. When market is coming down, you are falling less than the market. When these two combine together, that will give you that additional alpha for your strategy. So this is all I have for today's session. Let me quickly go and see if there are any questions. Please post your questions if you have any today. I still have some time in today's session. Let me just go see if I have any questions here. Okay, my question panel is not working today. I'm sorry. So we'll take questions another day. So thank you so much for watching this, and we will see you in the next one. Bye.